One is that you have to have accurate assumptions. If you are not looking at accurate assumptions of the numbers or the type of revenue you might be getting, whether you might make an assumption of a certain capital gain amount, or you might be making assumptions about a certain ordinary income amount. So it has to do with not only the amount of money, but also the nature of it. Your tax strategy is going to be less and less effective if your assumptions are off. So the more your assumptions are right on target, the better your tax strategy is going to get. Second, I would say that you have to have clarity on the constraints. So when I'm trying to put together a tax strategy for a client, I have to know what their personal preferences are. So if I'm putting together a tax strategy and I know that it might require a certain strategy to put money into a, let's say, tax-deferred account for retirement as a simple example, if they don't have the money to do that, I have to know that. Or if there are certain things that they're not willing to do, or they might have everybody has a different tolerance for the IRS and the risk, et cetera, and we want to make sure that we are working within those constraints, because the last thing you want to find out is that we put together a big tax strategy and invested a lot of time and money into it to find out that one of the constraints takes the whole plan, and really you got to start from scratch because it was just one factor you didn't have. So we really have to know the constraints, because we have to know if it's something that can be executed. Third, I would say, is the concept of the Rubiks Cube. The tax code is written in a way that we have different rates at different income levels. You have state taxes to look at. You have some items that are tax deductions and some that are tax credits. You have income limits for certain credits, et cetera, So a lot of times it could even be compared to Jenga, where you're trying to pull a piece of wood out and hoping the thing doesn't come crashing down. But on the Rubiks Cube, I always say, I can make one side of this look really good, but don't you care about the other sides? And then also know that when I put the Rubiks Cube together, if we change one of the assumptions or we change one of the constraints, three sides of this could get messed up and it won't be a clear color anymore. So you have to understand that when you start pushing something in one area, you have to know that what's the other side of that, right? Because I might be saving $10,000 here, but I just moved myself out of the income level for this child tax credit, which was $12,000. So you have to be very conscious of the Rubiks Cube concept when you're looking at the push and pull of a tax strategy.